If the market fell 20% next, would you panic or would you profit? The reality is that most people freeze when markets tumble. But the investors who understand how downturns really work often walk away with the biggest gains. That's why tonight we're unpacking exactly what to do now so you're positioned to profit as the market falls. Our experts, with decades of experience and trusted by major media from Bloomberg to Sky News, will show you the strategies professionals use to prepare and the critical signs that tell you when it's safe to step in. So if you want your portfolio to not only survive this downturn, but potentially thrive from it, stay with us. This is one episode you can't afford to miss. I'm Dale Gillham, joined by senior analyst Philip Tortevsky and Janine Cox, and we are Wealth Within. Good evening, team. How are we?
Fantastic. And yourself?
I've missed you guys.
Oh, thank you very much.
I've been playing in the fun and sun in Geelong.
Yes, lucky you.
I know. But Phil has done a great job with Pedro now back in the studio, and you did an excellent job last week wrangling the two boys. That wouldn't have been easy.
It wasn't. It was trying to herd cats.
All right, well, let's get straight into it. The All Ordinaries Index is down over 5%. Some of our biggest players like CBA are in free fall. Is this beginning of a 20% crash? Now I'm going to go to our crash expert, Janine.
Well, I know that the industry would love it to be a 20% crash. They're talking it down as hard as they possibly can.
But that's so they can buy.
Well, that's right. And that, they talked CBA down, and they're still doing it. I think Morningstar had an article, Morgan's had an article talking CBA down to $100.
Yep.
And I did some analysis, and I've recorded it for you in a podcast, so just watch out for that podcast on CBA. Do we think it's going to be a 20% crash at this stage? No. It looks like more maybe around 10% is possibility.
Well, that's normal, isn't it? Like normal, 8 to 12% is normal for this type of market. I'll get your comments too, Phil.
Yeah, I think it's actually really healthy. Yeah. Right now we're sitting in a position, we've spoken about this, even off air, that the market has started to accelerate away from that natural gradient of rise or that sustained rate of rise since 2009. And I think this month or this correction will be the most telling to tell us what's going to come in 2026, because like you said, if it's a pullback within that 7 to 10% radius, that spells bullishness for me. But if we get to something deeper, then I think we have a 20% correction could be on the cards. Still, that doesn't mean that the market's getting ready to crash. So we're in an interesting spot right now, I think, for the index. Yeah,
my advice is don't watch the media or mainstream media and those big players who do tell you those sorts of things like they said with CBA. But anyway, what I want to get into is, should people get excited now or should they be panicking now? Because that's what the big end of town want us to do, isn't it? With all these announcements, the market's going to crash, CBA is going to hit $100, blah, 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 all of that sort of stuff. So I'm going to get it from you, Janine. Should they be panicking or getting excited?
Never panic, obviously.
Yeah.
It's about preparing for a pullback and then looking at what the opportunities are going to be. I mean, if CBA pulls back even half of what they're talking about, then how big are the opportunities going to be on CBA?
That's a massive opportunity. Yeah. Phil?
Yeah, look, I agree. I mean, if you're playing the headline, follow that reactive game, then you're always going to be one step behind the market. So I think you should already by now be thinking, okay, where are the next momentum turns likely to come from? What am I preparing for? Digging into which sector they're coming from, which part of the market is actually falling. Doing real research, real statistical research to find out where these corrections are coming from and where, those opportunities are going to come in the early part of 2026.
Now, we're going to show some charts in a second, but before we do, last week I recorded a podcast on the neuroscience of decision making and abundance mindset as opposed to scarcity mindset about how people make decisions, especially in times like this, because I just thought it was really, really relevant. And it's probably going to be out this week if it's not. The guys just told me it went out yesterday. So head over to Talking Wealth, our podcast, and listen to that. It'll help you understand people, how their brain works in situations like this, like cortisol kicks in, dopamine kicks in as well, and how the stress hormones hit you and how that really does affect your decision making in times like this when we're seeing so much media media about, the market's crashing and it's really bearish. So head over to Talking Wealth and have a listen to that one. It's about an hour long, so it's a really good listen. So on your way to work, I know Pedro loves listening to them on the way to work anyway. Let's bring up the chart. So we've got 4 indices.
Yes, we do. We've got the All Ords Index, and then we've also got the top 20, the Small Ords, and I believe the Mid Cap Index, just to really see where these falls are coming from.
So this is big picture stuff bringing it down.
Yes, so we can really diagnose what area of the market is really falling at the moment, and what we can take from that in terms of opportunity. So first up, we've got the All Ords Index. Now we're down about 5.9% since the all-time high on the 24th of October. But to me, what I was mentioning before, and this puts it in a perfect visual for everyone, is that you can see that since 1982, the market was running to this really nice tune or rate of rise until in 2004 we accelerated away. And from that period, you monitor some of these pullbacks on that accelerated run. That was prior to the GFC, mind you. The pullbacks got a lot shorter, and that's what I was referring to before. The pullbacks will tell you a lot about where we are in the cycle of things and what's likely to occur moving forward, especially if we start to accelerate away. Now, we fast forward to today, and we've just started to break out of this sustainable rate of rise that we've seen since 2009. And so that's why this pullback is going to be so important. If we hold 6 to 7%, see really strong buying into December, into the start of 2026, then we can start having the conversation, well, hey, we've accelerated away to a new gradient. The market's going to get really, really bullish, and we know near the ends or near significant peaks in the market, that's often where the best opportunities come. If you can time it right, if you can get in and capture that really fast growth potential. So I think it's an exciting thing. It shouldn't be feared. It should be celebrated what's happening right now.
Yeah, I mean, just to, while I was saying that, I remember I did a podcast only a couple of weeks ago, about 3 weeks ago, on what to look out for with crashes. All the signs in the economy, the signs in the environment, all those things that you were talking about, and to know when it's going to crash and what to do about it, so you're making better decisions for yourself. So
I think
look
it's
at
also
that one as well.
I think it's also important to look at investor mindset as well.
Correct, which is all about that. It's what I was talking about with my last podcast that went out yesterday, was about how do we make decisions and how our mindset is affected. But the one I did on what to look for in crashes, etc., talked about human behaviour, human psychology, but also what was happening in the marketplace when we saw the 87 crash, the 2007 crash, the 29 crash, what economic things we can look for, and then compare that to today, because what we know is crashes are born on optimism and crash on pessimism, basically. So at the moment, what is happening in the market? Is this a crash environment or is this a pullback environment, which is what we're talking about?
And the longer we rise up and the stronger we rise up, it's going to be ever so important to be able to distinguish between the pullback and the crash, because you don't want to be thinking it's a pullback when you're on the onset of something much bigger. So that's why these charts are so important. It gives you that lens and that scope. But I mean, for me, that's what I'm seeing right now with this index. And even if we were to pull back, let's say that 20% number that they often refer about, but even if we were to do that, well, guess what? We've just fallen still into the sustainable rate of rise, where we could see a nice little dip from where we've seen it in the past. So
don't panic.
Yeah. That's the word.
Okay. Don't panic. All right, so what's the next one we've got? We've got 3 more to go.
Yeah, so next we've got the top 20 index. Now, this is interesting because to me, what's different about the top 20 index relative to the All Ords is the fact that where I've got this arrow marked here, you can see with the All Ords index, we broke through to a new high, whereas with the top 20, we failed to break through to a new high in October. Now, that's an initial signal to say, hang on, well, if our biggest players in the market don't want to get higher in terms of price, well, we might be seeing something in a bit of a turnaround story there, and we've seen that. We've seen, as you mentioned, CBA, CSL, big stocks, top 20 stocks get hammered at the moment, and this is the sector right now that is falling the hardest. So it's one to watch. They often say the big end of town turns first when we are likely to see a bit of a deeper correction. So it's something to keep an eye on, definitely for now. But again, hey, we've really accelerated away. So for me, I think what's really important right now to be watching, because with the top 20, the beautiful thing is the more they pull back, the more the opportunity becomes juicier.
Well, these stocks make up half of the All Ordinaries Index. So if the market's going up or down, it's these stocks, isn't it?
That's
really
right.
driving it.
Yeah.
And what's actually happening around these tops is we're getting exit signals on stocks.
Correct.
To sell. So that means if, most people who are following charts are actually, the risk is going off rather than on, which is a good thing.
It is, but when we're looking at how much money is going into passive investing in terms of, we're talking about index tracking ETFs, we're talking about a lot of money. I think, I'm doing the research at the moment, but like we're talking about billions of dollars going into this stuff, and obviously the money goes into that, and the index tracking ETF has to buy the stock, basically. That's what they've got to do, and they're buying these top 20 stocks. But when we're seeing what Phil was talking about, these turning around, that's giving us a big signal, isn't it? It really does give us a big signal about, okay, well, where is the market going? Can it go down further? I don't think it can. I don't think it's going to do 20%. I think it'll be the normal pullback. But hey, I'm prepared to be wrong, because it's not about how far it goes up or down. It's what you do about it, isn't it?
Exactly.
It's at the end of the day, it's all about how you profit from it.
Yeah.
And you find that opportunity. And I think that's what you said is huge, because over the next couple of years, I think the passive investment story that has been so popular is going to get a big reality check.
Huge.
Because, I've spoken to so many people, people that before they came to us were, hey, I'll just buy the pullback or I'll just buy the dip. And I assume that the market's going to keep doing what it's doing, but at some point it doesn't.
It doesn't.
And is that the best way moving forward in terms of getting the most out of it? Yeah.
Well, when's a dip, not a dip. So, but anyway, so if we finish with the top 20?
Yeah, so that's the top 20 right now. That is where the, significant falls are coming from. We move over to the mid-cap 50. And this is where it gets exciting, right? Because the mid-cap 50 is also taken out to a new all-time high in October, and it's managed to hold the September low for now. So this is the most bullish out of all the sectors. The All Ords, if we go to the weekly time frame, you'll see that it took out the September low. That's definitely taken out the September low, looking the weakest top 20. But the mid-cap 50 is holding really strong and only fallen 5.65%. 5.65. So right now, in terms of market structure, this is looking the most bullish. And that's quite cool, because when you start moving out of that top 20 into the mid-cap 50s, you're seeing more volatility, which means more opportunity. And the fact that it's holding, that's a nice sign for me.
To me right now, the difference between, and Janine, you can probably talk about this as well, because we've been around a lot longer than what Phil, but I've been around a lot longer than you, so you're still young, okay? But back in the 80s or 90s, even in the early 2000s, the moves down weren't sharp and fast as really. I mean, obviously 87 was, but that was a lot of computer-generated stuff, because we only just brought on computer-generated trading in 87. So there was a bit of thing there. But we're seeing a lot more of these pullbacks being really sharp and fast. They're not necessarily more protracted. So is that what we're expecting right now, Janine?
I think that we can make a mistake in just assuming that it's going to do the same thing over and over again, because eventually it won't. And so that's why it's important to think back even further, as we do on the chart, to show us what happened in the past. So you're talking about these pullbacks that happened before the GFC that we went through, and we saw them happen for a month or a month and a half, and then the market turned around and went back up again. So what you're saying is that it could be more volatile. There's a potential for it to be more volatile, but the timing's probably going to be the same sort of thing on a bull run.
Well, that's important to know, isn't it? I mean, obviously, the two things we teach people is direction and strength. They're the two major things, is what direction is the stock or market going, and what kind of strength is it going to have? Is it going to be really strong up or really strong down? So that's really what we're looking at the moment. So at the moment it's down, but the strength we're sort of talking a bit about, aren't we?
Generally, when risk comes off in the market, it comes off the more riskier stocks, because they're the ones that are more exposed in theory. So ones, say, in the mid-cap that have gone harder could come off more than stocks in the top 20.
Okay, the last one. This is small ordinaries?
Yes, and that has been, the stellar performer over the last couple of months. It's really flown, shot out. You can see the move that we've had since August. This has been the best performer. It's actually pulled back the least of all these sectors. So I correct myself. The mid caps.
Isn't that more? Is that 6.9?
That's surprising.
My eyes are really
6.9
off today, aren't they? No, I was right.
6.94%.
There you go.
You're making everybody squint at the size of that one.
I was right, but the way it's taken off really shows that the small cap sector has now found a whole steam of buying, and I think this pullback is not unexpected. You can't have a move like that we've seen without a pullback for it to be healthy. So I think watch this space, because the next pullback in the small ords might give, I think, probably the safer opportunity before we get that third run up.
That's not unusual. Like, obviously, when we go to a crash, you set the big end of town turns first. And you see the small stocks taking off simply because people are looking for value. They think, your Cochlears, your CSLs, your CBAs, all of those are too expensive, so I'm going to go for these small, cheaper stocks. So you see those go in the last part of a bull market. But it's also...
The small ords hasn't even gone through its all-time high yet.
Yeah,
so that's telling me big, thing that against what the institutions are saying.
There's opportunity there, isn't there? Yeah. There is opportunity there, because obviously at the moment it's had a stellar rise over the last few months, but obviously it's coming back a little bit now, which is what Phil's saying. There's still opportunity there. So at the moment, but anyway, that does wrap up our first round. But don't go anywhere, because shortly we're actually going to show you which 4 stocks from the ASX mid-cap sector that are setting up for amazing opportunities right now. But now's time for our trending topic this week. Janine has got a ripper for us.
When a stock falls 33%, should you try to pick up a bargain? Now, before we take a look at the charts, we've seen many stocks fall heavily, become oversold, and later rebound strongly, providing savvy traders with a great gain. Can ASX Telco TPG do the same? And what is really going on? Could it be a reaction to another 000 death?
TPG says one of its customers died after failing to connect to 000 emergency services. The telco is blaming the person's Samsung phone, which was running on outdated software and was incompatible with 000 access on TPG's network. So this is very different to the other outages we've seen from other networks. This is down to outdated software on the individual's phone.
A sad state of affairs. Now, or is this because many Australians are just fed up with telcos?
We are joined by Telecommunication Industry Ombudsman Cynthia Gabert in Melbourne. Cynthia, good to see you this morning. So these statistics highlight our complete lack of confidence in the telcos.
Yeah, we did see relatively stable complaint numbers, but the fact that we have had an increase in people reaching out for compensation because they're fed up, to be honest. They've had enough with outages or poor service or repeated attempts to get things resolved, and they're coming to us frustrated and concerned they've got nowhere else to go.
Now, Telstra's shares have held up well, but it's neither of these. This is why you should always do your research before you buy. It turns out that TPG had a capital return to shareholders for the sale of some assets to Vocus. Shareholders pocketed some of the proceeds, and the rest is being used to pay down debt. That's got to be a good thing. Even if you're not holding TPG, this could affect you. Now, here's what you need to know. So let's take a look at the TPG chart. Now, this would give anybody a heart attack, if they're, looking at it fall that sort of percentage. But what often happens is when there's a company, who are selling off a part of the company, essentially, and they're giving the return back to shareholders, there's an adjustment that needs to be made to the stock chart. And we haven't seen that on TPG. And over the years, how many times have we seen stock charts that, are sitting there unadjusted for a while until that occurs later on?
Oh, some of them, depending on your data provider, if you don't have a good data provider, it could be weeks and weeks and weeks, whereas we've got a good one, it's done pretty quickly. But can I just say, this is like this whole thing with TPG splitting off, it's split off, it's fibre and data network to Vocus. So if you had NBN with TPG, it's now with Vocus. If you had fibre connection with TPG, it's now with Vocus. That's been going on for 6-7 months. This is not something that just goes, today we're going to sell to Vocus, and it goes. So if you've been an investor in TPG and you didn't expect that, something's wrong.
Yeah, because you should have been following what was happening. You should have
been following, because we, as a business, we're a TPG client. And I'd known about it for so long, it's not funny.
But does this then create an opportunity? That's the question, isn't it?
Well, it is. Is it an opportunity? opportunity? And I'm sure you're going to tell us.
Well, look, quite often people think that it is, and they think, all right, I'm going to buy the shares cheaper. But essentially,
That didn't tell me anything.
essentially the company's worth less, than what it was if it's returned that money to shareholders, right? So that's the first thing to think about. And we look at the chart again, we can see that it's gone through these lows. Now, I would just wait. If you're looking for an opportunity, there might be one. So this could actually be a sort of a line in the sand moment when companies do a corporate restructure, or they do a corporate action that affects the company, that like it can, is to have a really good look, because prior to that, the stock looked like it was starting to make new moves and go to new highs. So I would suggest that there could be a big opportunity here, but just wait for the dust to settle and see how TPG looks on the chart over coming weeks.
So you're saying don't buy the dip just because it's fallen so heavily this week?
Exactly, and don't panic sell as a result of what's happened either.
All right. Well, that sounds pretty good. I mean, I hate all telcos anyway, so, it doesn't matter what the name is on my bill. I've said so many times to our business people, I don't care what the name is on the bill, as long as I get a good deal, but they've all got lousy service, haven't they? But if you do want the skills to analyse stocks, just like you've seen tonight, visit our website, wealthwithin.com.au. But now let's get back into our topic and get into some more stocks. I'm going to throw to you, Phil.
All right, let's go. First up, we have Soul Pattinson. Now, I mean, this is one of the oldest stocks on the ASX, and it's an absolute ripping stock. I mean, when you look at a company that's been around since 85 and consistently being able to break through to new all-time highs, it's really, I mean, we did an article on this a while back. We called it Australia's version of Berkshire Hathaway, and you can't fault it. Right now, what we're seeing is potentially, given the way it's proven itself throughout history, I mean, just looking at these pullbacks as an opportunity more so than something of a fear, that really lends itself right now to potentially another one opening up. So I'd be watching this level through here, following the momentum as it's going up. We're coming into a level at around that $34, $35. Really watch this stock, because you might get an opportunity that hasn't been around since November 2024. But just like you mentioned earlier, Dale, trying to catch stocks as they're falling is not what I'm saying here at all. It's using that C letter word confirmation correctly, and that might mean giving up a little bit from the down, but getting into that safe part of the trend. That is the best play with Washington Soul Pattinson right now. But hey, the longer these dips, history has proven that the opportunity comes shortly after.
Yeah, when you got a good stock that's well managed, it just pays to keep your eye on it and just have a focus. And this stock's a really, really good stock, or one of those ones that's been around for a long time.
Dividends since 1990. Yeah,
well, it's actually been around a lot longer. We've only just got data from back in the early 80s, like we have in most stocks, because prior to 87, or before the amalgamation of all the exchanges, because we had exchange in Brisbane, Sydney, Melbourne, Adelaide and Perth, they all got amalgamated back in the mid-80s. Before that, there was like 5 different exchanges, so data was a bit sketchy. So that's why we don't have that data going back, but they've been a long-time company. Now, I know you're champing at the bit to say something, Janine. Are you going to look at the next stock?
I'm just waiting for my cue.
Yeah. Okay, here's the cue. Take it away, Janine.
Okay. Whitehaven Coal. Now, this one, love it or hate it. It depends how you look at it.
Love it.
The chart looks beautiful, I can say that. It's just absolutely magic, just seeing how this stock has unfolded. And this is what we call a fairly orderly correction. To some who may have been holding on to it, you may not have felt that it was too orderly. Falling down into that low in April 2025. So off the top, that was around $6 off the all-time high that it fell. But since then, it's actually starting to show signs of a recovery, which is amazing to see. And I think it could be early days yet, the way that this has unfolded, and the potential to the all-time high is there. If we're looking at the upside there, that's 55% potential. And there's huge support across these historical highs. So Whitehaven Coal, that price support is massive. And I think that if you decide that this is a stock for your portfolio, that you'll be able to find a really good set of rules. If you've got the skills, like we teach, you will find a strategy on this one. It's really nice.
Good. Any comments from Phil?
Oh, no, I like it. I mean, the big super funds, Australian Super's really vocal about how they're in on this stock. It pays a really nice yield, and it's coming off one of those, as Janine said, real significant corrections, holding above these two levels. I think as long as it holds that level that Janine's marked, $6, this stock is leaning more bullish than bearish. So watch $6 like a hawk.
It does look nice, doesn't it? Anyway, well, if you want to avoid any stock market crash that we might have either today or into the future, then grab a copy of this book. It's free. You just got to pay the shipping. Now, I know you won't get caught in a crash if you read it and follow the rules, simply because the book, the first edition, was written before the 2007 GFC crash, and everybody that read it and followed it missed the whole crash. So have a read of the book. It's perfect time for you to get your copy. Just hit the link in the description below and you'll be able to grab your copy. As I said, it's free. You've just got to pay the shipping. Now, we've got another stock, and I'm going to go straight to Phil for this one.
All right, next we've got Worley's. Let's go to the chart here, and I mean, I'll just keep things on the monthly chart. This is a stock that has been, I guess, relatively unloved over the last couple of years. But that being said, we're not seeing any real significant corrections, and that's what I like. That's what's promising since COVID, and that was a bit of a telltale sign for me. We hit the all-time or a major low in 2016, and with big stocks like this, especially stocks in the top 20, top 50, or even the mid-cappers, when you see them go through these cycles, they have this huge appreciation, then they go through their downtime, find their feet, and then start getting ready for that next leg. Oftentimes the price action can be quite choppy. It's not always clean. And so when we look at what we're seeing right now with this stock, we're showing all the hallmarks of a stock getting ready to potentially break out over the next couple of years. So when I look at what today, the way it's unfolding, it's so important that the COVID low didn't take out that all-time low. I like the fact that that's happened, but we are stuck in that sidewaysy type range. So I think right now for investors, treating this one as more of a medium-term opportunity, more so than trying to take it as a long-term opportunity, because we're not really broken out into that expansion. And I think if we, start to take out these levels through here, around that $19 or $20 mark, then we could start to see it as more of a, more medium to long-term opportunity. But for now, while it's range-bound, it's showing real promise from 11 to 20. And I think if you have that hat on, trade it in that medium term, short to medium term, take the opportunities when they arrive. I think it's providing some nice trends, and a mid-cap 50 stock with volatility that trends well, is one to put in the portfolio.
Now, Janine, I know you're expecting materials to lead the market over the next 12 months. Am I correct in saying that?
Given the size of materials in our market, it's really stumped me that it hasn't gone further at this point, but it's the talk about China that's been holding it back.
Well, the reason I asked is because this stock runs with materials, doesn't it? So it's sort of like, it's one of those stocks.
It tends to run with the oil and energy stocks.
Oil and energy stocks.
Yeah.
So how about you talk a little bit about that? Because obviously this is the opportunity right now, because it's a bit more broader than just the stock, isn't it?
Yeah, it's in both of those areas, obviously, in terms of its exposure.
Yep.
So, we've been watching Worley for a long time, and it has all sorts of projects across the globe. I like the fact that it's actually changed its position in more recent months, and it's started to move up off that low, because that's showing that low is more likely to be the bottom, and that we're now seeing it step higher. But still, there's a few hurdles for it to get through in this resistance across the medium term here. If it does that, then I think Phil's exactly right.
And the other one I'd probably look at would be Monadelphous, if that's happening too, because that also tends to run with the materials sector as well. But can we go and have a look at the last stock that we've got, because I'm actually excited about this one.
Okay, so this is Dyno Nobel, code is DNL. And look, I have had requests from people for us to say what the code is, because we've got people listening to this as well as watching the audio and visual.
They listen?
Yes, they actually listen to it instead of just watching it. So
that's
I
really
don't
good.
get to see your pretty face.
Well, I don't get listened at home, so that's exciting to me that people listen to us.
Okay, so if we look back at the chart again, we can see that there's this long-term resistance with Dyno Nobel. And I mean, depending on where you want to draw your line, I'll just bring it down a little bit. Obviously, it's coming up to those levels. There's some, like what we saw with Worley, there's still some upside potential there, at least around 20% before it hits that. But given the way that it's unfolded, it's actually come back, tested these prior lows, long-term lows, and that provides some support as well. It's done a retest here in 2025. So we've seen it take out these highs. That's pretty important right now, and the trend looks beautiful. It's all up. The question is, would you be buying it right now? If you weren't in it at this point, I would say, you probably missed that run, but I would still wait for a pullback and an opportunity to get in it, because it looks really good. So I can see why you like it.
I mean, when the market that we've had, obviously, when was that all-time high? It was August? Is it August?
Yeah.
It was a few months back anyway. Yeah, and how that market's been behaving, and yet this one keeps going up at the moment. So it's a nice looking stock at the moment. So I really do like it. So I'm going to ask you a really tough question, each of you. Which is your favourite out of those four? I'll go to Phil first, and then I'll let Janine bring it home.
Look, this is not like me, but I'm going to be safe. I'm going to say Washington sold patents. And given in the environment we're in today, if it were to get worse and a bit more of a prolonged downturn, I think having a safe approach with a stock like Sol, you can't go wrong.
Okay, now before I ask Janine, a Tatslotto ticket's riding on this, because if you two agree, I'm going to go and buy a Tatslotto ticket. So who's your pick?
Shall I do it?
Do it.
All right, I'd like to see you buy a Tatslotto ticket.
Doesn't happen very often.
No, that's right. So
never happens.
I'll pick Sol Patterson, closely followed by Whitehaven Coal.
Whew, looks like I'm visiting the local newsagent. I can't remember last time I bought one, but I thought, if you two agree, it's just got to be an omen, doesn't it? So both of you are going for Washington Sol Patterson as their stock tip. So well done, guys. Anyway, moving on shortly, we're going to get into our hot stock tip, which is an absolute beauty this week. But first, let's answer your questions. Now, Chris writes, I first purchased AMS on the 22nd of March 2022 at 84 cents, and I added to the position in April 2022 at 78 cents, only to see the stock fall away significantly. Now, eventually ceasing trading, it relisted, and the business appears to have undergone a major clean out. I bought it again at 1 cent, which has brought my average price down to 3 cents, with its latest report showing a positive EBITDA and upgraded earnings guidance, and the share price now touching 4 cents. I'm interested to hear your thoughts on the current outlook for AMS. Who do I go to? Do you want to tackle this one?
I just looked at that and shook my head. I mean, I feel sorry for him for a start. Because that must have been really painful to watch, those two positions that you purchased. But to buy it once when it's gone down and then again, you must have bought on, did he say bought it on news or some story? Because why would you when the stock's just going down like that? Because if nobody else wants it, why would you want it? That's the big question, isn't it?
Well, that's true, but it's a process issue for me, not a stock issue.
Yeah, exactly.
So, I don't know, do you want to make a comment?
Yeah.
Because we have to help Chris.
Yeah, and I think the worst thing that can happen here is you fall in love with what you've done and you think you've done something that, you should do in the future. And what I mean by that, if we go to the chart, is the initial purchases, there were two at 84 and 78 cents. Now, the third purchase that was at 0.011, bringing the average buy price down to 0.03, meaning this third position was way bigger than these first two. If
absolutely.
Brought the average buy price down. So it's gone
huge,
harder as the stock's, really down to almost nothing. So to have that high conviction on a stock that has fallen from $1.80 to 1 cent, more often than not, you're playing a very dangerous game, because, the stocks fall for a reason. And in the case of Atomos, there were real concerns and issues with the company. Now, you're banking all of that on and doubling down on a structural change, which at this end of the market could take years, may not eventuate. So now you're in a position where you're up based on what you've done, and you're wondering what to do next. So to me, they're all the concerns. I think if these questions exist and your conviction is not the same as it was originally to pick that third position, because you've done it for a reason, you obviously think there's something good about this company, then I think the best option is to take a lot of the risk off the table, because you've been given a lifeline here, and next time use that word confirmation that we often speak about, which will alleviate a lot of these situations. It's not always about just trying to get in or trying to get in first thinking you're going to get in at the best price, because when you do that and you wait for confirmation, you avoid this exact situation. So that's all I want to bring up about it. I think, you're in a situation now where you can basically, get out with something in your pocket.
Well,
so
to me, and I'm not trying to be rude to Chris, but every single decision he made was just wrong. Totally wrong, and that's what you're saying, isn't it? Yeah, you're doing it in a bit more softer way than me, but every single decision was wrong. And yeah, he's getting out of it, and it's not because of good management, it's because he's just put a lot more money in at a high risk point. Because Atomos is the company, and I've known this company for years, and I knew what's going on. I mean, when it was $1, I was saying if it gets to $1, buy this stock, and it went to $1.80 or whatever else. And I said this is a short-term trade at the time, and that was about 3 years ago. But since then, it's been a dog. You know, it's had no CEOs, it got rid of CEOs, its workforce is like about a third of what it was 3 years ago. It was in a trading halt for well over 18 months because of issues with its accounting methods and things like that. There was a court case from a former CEO that got sacked. There was so many things going wrong. Now, I'm not saying it's not a good company. It's a Melbourne-based company, and it's got new CEO who is the former founder of Black Magic, which is another Melbourne company, and I've met that guy. He's a really nice guy. So I'm not saying it's a bad company. It's a good company. Just, Chris, your whole strategy was completely wrong, and you really do need to read my book, because if you want to repeat that sort of strategy on another stock, you're going to lose big time, and you've taken very, very high risk. So please learn from this experience, and I think that's what you guys are saying too. Learn from what you've done and don't repeat it again. It's not a stock thing, it's a Chris decision thing, so make better decisions next time. But let's move on. Now we've got Christopher's email is next, and he says, I've been looking at James Hardie. It is a good or at a good support level. In the past, it has come to similar levels and bounced off it and continue its run up. Now, I personally don't see the building materials they supply to slow down, and their new acquisition of an American company, they should continue their run up. There is a lot of negativity around the company for the acquisition, and James Hardie is currently in a strong downtrend, but I feel there would be a good opportunity to trade this one. Just wanted to hear your thoughts on James Hardie and the chart. Okay, go Phil.
I just opened my mouth and you didn't even give me a chance to say anything.
But you can ladies first if you like. Would you like to take this one?
Thank you. Yeah, I do.
I know you don't like the small ones like Atomos, so that's why I went to it.
Yeah, I really appreciated that.
Yeah,
Thank you.
so you can have James Hardie.
All right, fantastic. Now, I mean, this stock has been in a big decline over recent times, and people think, oh, look, you know, it's getting cheaper, it's a good opportunity, I should buy it. And we've had people write into the show about it before, particularly around the time that it went up, and we were looking at it as well when it made that move, and just thought, no, it's way too much risk. It could be just coming up to fill that gap off that bottom, and, you know, the angle of the overall trend coming down might just kick it back down again, which, you know, thankfully, the analysis proved true, which it does quite often, but then it stopped down here in August 2025, went sideways for a little bit. Now, people who are trying to bottom pick would think, oh, it must be over surely, you know, that it's all done, but no, it's come down again. This could be the bottom, but it's way too early to even pick it. Is this a stock that you should be watching? Yep, I think it's a really good one to have on the watch list, so well done for picking it up. Looking at that long-term angle of the trend coming up, you can see there that it's really come down to that level. Could it come back all the way to this low here in COVID? Yes, it could, and that's the real risk with it, but it's about crossing the I's and dotting the T's. So what are your rules? That's the first thing. Make sure you've got good rules, a good stop loss. You've analysed the history. You've done one of our courses to know, because this is a riskier stock. Even though it does trend beautifully at times, when it sells off, as you can see, the sell-offs are quite swift and harsh on those moves down. It's got a bit to get through. It may actually allow us to draw a steeper angle down here at some point, so that's something to be watching for. But more medium to long term, investors or traders would be looking for this line to be broken. It just depends on the time frame for your trading, how close you want to get it.
Yeah, I mean, there's a lot of stuff in his email, isn't it, on, you know, this acquisition and building materials, and there's a lot of assumptions. A lot of assumptions, but at the end of the day, it's either going up or down, and he's rightly picked it, it's going down, so it's not a buy yet. So, but I did say there was a lot more volume in it the last 12 months.
Yeah.
So, I don't know, what do you reckon, Phil?
I think this can all really be simplified with, if you're looking at these types of opportunities, identifying the reversal correctly with confirmation. And I think if you can answer that and you can do that, then you should be looking at something like this. If you are unable to do that, then my, I guess, honest advice is go and get educated. That's it.
So what I'm reading for both of our experts here, Christopher, is that trade on confirmation, keep it on your watch list and wait for it to confirm it stop falling and start to move up. I think I got that right, cross my fingers. Now, Jamie is next and he writes, I was recently doing some research and came across IGO on the ASX and I'm thinking about entering the stock very soon, if not ASAP. However, most of the recent rise happened last week. So do you think waiting for a pullback to around $6 support would be advisable, or due to the current potential hitting this now and setting a stop for the $6 range? Go, Phil.
Good question.
Very good question.
Yeah, let's bring up the chart of IGO because, it's common. We all want to get the best price. I totally understand that, but more than anything, it's, I think to answer this, he needs to, and I hope it's a he, needs to answer the...
Well, I was about to say that. I said Jamie, but it could be a he or a she, can't it?
Yes, yeah, well, they. I mean, we can use that in today's world, can't we? Can answer the... what's the purpose of this trade? And I say that from the point of view, is this a long-term trade? Is this a short-term trade, or is this a medium-term trade? Because to answer that, answers really whether or not the pullback is important or not for what you're trying to do. Because if we're looking big picture long-term trade, well, there is, I guess, reason to say right now the opportunity could get there. And if it doesn't pull back, will you be kicking yourself to say, well, did it really matter that I gave up, where are we? Where's the price percentage tool? That I gave up 9% in the grand scheme of things if I was looking for a move up to 11, 40 or 50. And so if I'm more of a short-term trade through here and you're applying some tighter risk structure to it, well then it's probably more important that you do get through to levels that are more conducive within the volatility of what you're trying to do. So I think that is the most important question to answer. Nevertheless, the fact that the stock's come back to this $4 level, I think it's poised, even whether you look at it short, medium or long term, for real opportunity to grow. Because, I mean, if I just apply that horizontal line over the $4 mark, it's been huge, and even a little bit lower, 330, since 2008. So I love that he's looking at this stock now. Buyers are starting to support it. It should have turned at 350. It has done that. It's just a case of what you're looking for, how far it's got to go, and whether or not that risk reward makes sense, whether you wait or not. Because, it may not, or it may come back down to there. Does it really matter based on your strategy?
I agree with all of that, and I think I'm going to ask you a question in a second on this one, Janine, because to me it's about if your rules trigger the buy, you buy. It's pretty much, that's what it is. But it sounds to me, if Jamie doesn't have solid technical rules, he or she, Jamie, may have some good fundamental reasons for buying the stock. And if there are fundamental reasons, then you just buy it anyway. You forget about it. Don't worry about the price, because the fundamentals are more medium to longer term. Whereas technical rules, if they're triggered, then you just buy that. Do you want to give your thoughts, Jane?
Yeah, I think that's a real conundrum, isn't it? For when you're juggling the fundamentals and the technicals, or you're only running down one lane and you can only see what the financials show. That's a real conundrum, because I think that's where people get hung up.
Yeah.
Because the fundamentalists are thinking that, okay, it's got value there, but at what price? All of a sudden an article might come out saying, we think that it's not undervalued anymore.
Yep.
Hold, and they change their status. And so the fundamentalists, they stop buying for a while. And then we see the sideways action happen on the stock. Technical analysts, depending on whether they're short, like Phil was saying, short term, have a totally different structure, short to medium term, to someone who's medium to long term looking at it. But even still, you have to consider where your stop loss is going to be placed.
Yeah, correct.
To me, that's the most important thing.
But 9 out of 10 people don't have one.
Yeah, and if you're looking at it and then the stock reverses, where are you getting out? That's the key to it all. And does it make sense from a technical point of view where you're placing it?
Well, to me, it's about if Jamie was buying it on fundamental reasons, then price is irrelevant, isn't it? If you've made the decision that EPS is good, dividend yield's good, the PE ratio is good, whatever it is that you've used to signal the buy, then just because it shot up last week is not a reason not to buy that. That's sort of what I was getting at.
So why the hesitation?
So why the hesitation? But if you're using a technical entry and technical analysis on it, and it said to buy, then you just buy. But I'm thinking there's some sort of it's shot off too high, so there's emotions now into that decision making. I could have got that, but I'm now not. But what if it drops away and I bought it now and it drops away? I understand all of that, and that just means having better rules around what you're actually doing, Jamie. But really good question. Love the stock, and I love the discussion that we've had on that stock. But now we have Liam's email, and he's looking to get your thoughts on SPL. It has gone back to the 42 cents level after a long time, but I don't think it's proven enough yet to warrant a buy. If it breaks through 42 cents, I think it could go for a run. I'd be looking at this for the short to medium term. So what would you like to see for an entry here? Great question from Liam. Janine. He's asking, what do you think for an entry? So we're asking the wrong person, aren't we?
You're asking look, I would have personally liked to have seen something happen on the monthly. And the reason I say that, and people think, often on the show we talk about stocks on the monthly chart, and people think, you can't trade the small stocks on the monthly. But look at some of these lows down here. It actually did a retest of that low and then took off for a couple of months, and there would have been a good short-term trade in there. But then there was this choppy sideways period all the way through here. Well, what if the stock now gets stuck in a choppy sideways move? It could very well do that. And sometimes you've just got to give away a little bit off the bottom to enable yourself to get into the better rise, which, maybe it won't stop until it gets to around 60 cents as a possibility. If we come back to that weekly chart, the entry's already there. If you were short to medium term, that's gone already, I would say, until the next time it pulls back.
Now, this stock, correct me if I'm wrong, Phil, was at the recent microcap conference, Star Pharma?
Yes, it was. There you go.
See, I'm not that old. I do remember things.
There you go.
But it was at the recent microcap conference 3 weeks ago that both of us attended.
Yep.
And it looked really, really good there. So it's not unusual what we've seen it taking off. It's gone up a bucket load since the microcap conference. So would you get into this now, or you'd just be holding back?
I think with these kinds of stocks, timing of entry is crucial. And I say that because when you get in, these stocks are so volatile that if you don't have an optimal entry, more often than not, if you're chasing these kinds of stocks with the FOMO, right now you could be considered to some degree chasing. When it does turn, you're quickly going to be in a situation where you're in a loss. And so I think more so than the big players, these ones here, really timing that entry needs to be spot on so that you can give yourself that chance to allow for slippage, to allow for the low liquidity, all the disadvantages you get at this end of the market. What I'm seeing today, the fact that it's gone up on that chart, it's gapped up through on the 26th of September, I think probably there was your opportunity. There was a telltale sign. There were some opportunities a little bit before that, but there, and maybe there was one more opportunity today. I think it's much higher risk. And I say that from the point of view in terms of if you get in, where are you going to place your stop? And will it be enough to be safe, one, but two, not get you stopped out?
Yep.
And I think today's situation probably lends itself more to if you get in, potentially any reversal might get you taken out before you see further upside. But that might be okay if that's the game you're playing, if you're willing to get back in a second or third time. So not optimal, that's all I'm going to say.
So, Liam, nobody gave you an entry signal because it's not there, and they've obviously given you some great advice. Now, if you do want to see Star Pharma's presentation from the recent microcap conference, along with 23 other microcaps that presented there, you can email us at info@wealthwithin.com.au, and our team will be able to send you the link to be able to go and access all of those. And you can see there with Star Pharma rising, 300-400% over the last month or two, how much money you can make if you get this stuff right. So one trade will more than 10x your profits, basically. So, as I said, info@wealthwithin.com.au if you want to get the link to find out where those presentations are, or the videos of those presentations are. Anyway, now moving on, we've got Stavros' question is next, and he says, I'm new to investing and I'm looking to put some money toward a longer term position. After watching last night's hot stock show, I'm considering investing in Cochlear, but I'm a bit hesitant because the share price is already quite high and I'm only starting with a small amount. Is it better in this situation to look at smaller, lower price stocks instead? Really great question, this one, isn't it? Because it's a question we get from a lot of new investors, Stavros, and I'm going to throw to Janine to answer this, but buy the book, it'll help you answer all of that question and bucket loads others. So, as I said, get the books for free, just got to pay the shipping. Links in the description below. What's the answer?
So if you can get all the answers from the book, do I need to say any more?
No, Janine's going to shut up. Let's move on. No.
It's really two parts, isn't it?
But you've got a better answer, haven't you?
Not than you. One's the stock.
Yep.
And the other issue is the position size and what to do with that and the risk around it. So the first thing is the stock is a good stock. There's no doubt about it. Should you put your money in there if you've only got a small amount of money? My short answer is going to be no. That's what I would say to anyone looking at that who's starting out in the market's got a small amount of money. It's all risk. Because Cochlear, even though it's a big stock, it can be quite volatile, and at the moment it's pulling back.
Okay, so it's not about the price, it's about the direction and the risk.
It's the direction and risk.
Okay.
So he'd be far better off exactly following what Dale said and using that money in the top 20 stocks and starting out like
Cochlear
gradually.
is in the top 20 stocks.
Oh, it is too. I forgot about that. But I would pick something outside of health at the moment until it's going up. And I'd rather see your money go into the banks when they pull back at a better time.
Okay. Phil?
Yep.
Look, I think putting $1,000 in a Cochlear is okay. I mean, it is a top 20 stock, and I think his concern is that
long term.
Yeah, it's long term, and you know whether it's $1,000 in CBA, Cochlear, the costs will be the same. I think where he's getting confused is the fact that because it's a $300 stock, he thinks that
it's only 150 now, I think, isn't it?
Well, 270 at the moment.
Oh, 270.
270.
Come off.
He's thinking that if I only have $1,000 and it's 270.
Sorry, CSL, it's 150.
Yes, that I'll only be able to buy X amount of shares versus if a stock's $5 and I'll be able to buy more shares, meaning I'll have more stocks and more potential to grow. But that's not how it works. Your $1,000, whether you put in a $500 stock or a $2 stock, you still have $1,000 worth of risk on the table. So it's only $1,000 that can multiply or drop. That's the first point. And honestly, Cochlear, a company, we covered it off yesterday. Yes, it's pulling back, but when I go to that monthly chart and zoom out big picture, it does have corrections, but it's proven throughout history that it's always going to break through to new all-time highs.
That's good.
And we covered off the fundamentals of it a little bit yesterday with Pedro in terms of the moat it has, in terms of, I mean, this has got a business model almost like Apple. Once you become a customer, you're a customer for life in terms of repeat business and let's be honest, the Australia's population is, and globally, I mean, this has 60% market share in the space, in where they are, highest in terms of research.
That's going to change in a year or so.
In terms of research and development, and in terms of client base, we're moving into this ageing population that's growing, that in reality we are getting more and more deaf as we get older. So.
Okay, what'd you say?
But yeah, I look, for me, I think this is safe enough. If you want to dip your toes into the stock market, I have no issue with Cochlear.
All right, so there you have, great answer. It's not the price of the stock you need to be worried about, it's the actual stock itself. So good answer from both Philip and Janine. Now's the time for our hot stock tip for the week. Now, because Pedro's not here, it's Phil.
Yeah.
Well done, go for it.
Pressure's on, all right, I forgot how to do this. Hopefully it works. The hot stock tip is BlueScope Steel. Now, before we get to the chart, take a look at the news that came out today. Now, BlueScope has confirmed its earnings guidance for the first half of FY26, with results expected to be at the bottom end of the $550 to $620 million range. So a little disappointing, but while Australian operations are experiencing cost pressures and softer pricing, the standout is North America, where earnings are set to jump sharply. Asia is also showing slight improvement. So overall, the short-term picture is softer than hoped, but the company continues to push cost improvements, land monetization, and long-term growth initiatives that signal confidence long-term, especially what's coming out of North America. That is very positive. But let's get to the chart, because to me, this is where I
know
guess
there's a lot of talk around steel and steel production at the moment.
Yeah. And the big players or the big markets are the ones that are starting to fire now, which is exciting for them. But when you go to the chart, I think that's where it gets even more interesting for me, because you're talking again about a big stock that really hasn't done too much. And you can't say the same for a lot of its constituents. You've had, Rio's taking off now, BHP's taking off, Fortescue Metals is taking off.
Yeah.
All the other players are really going for it, whereas this one's still stuck in that sideways range. But what's promising about it is that it hasn't really fallen, if it was going to correct, it hasn't really corrected. It's just running nice and uniformly to this momentum. Now, the news that came out today, I think if this chart is updated, what are we at here? That's the 21st of November. Let me put it to the daily chart.
Has it got today's data on it?
No,
that's
the 17th, yesterday's data. Now, today's data, the way it looks, in fact, it's opened lower and it's closed up higher. So the bar looks pretty much open through here and close up there. So whatever news has come out today with the softer stuff, it's being picked up by buyers heavily. And so I wish I had the price action to show you that, but we're seeing a lot of buying on the news today, which is very promising. The only issue with BSL right now for me, and this is something to watch that I'll be watching very closely, are these highs at $25. It's held it up for quite a while. We're getting that compression now. Sooner rather than later, we're going to find out. That's the real exciting bit. And as long as we hold this momentum line, start breaking through 25, I think the next move out is going to be quite explosive. If it breaks through this momentum on the downside, then I'd say, all right, forget about it. It's not ready yet. But this price action of compression, just getting ready, testing highs at 25. If it's not on your watch list, then I think it should go on very soon.
If you do want to learn more from us, check out our video, Don't Sell Your ASX Growth Stocks Before You See This.